Jordan.
All right, let's do it.
How's it going, everyone? Happy Friday. Welcome back to another one of our Friday streams. Jordan, I can't lie. I think this is the one that I look forward to every week the most. I feel like we get such a good conversation going on with all the questions coming in the stream. We get to talk about topics that are, particularly relevant for the week a lot of the time. I just feel like it's overall just a great thing.
Yeah, happy Friday, guys.
Yeah, we finally got some nice weather here in Toronto, so we're going to be doing a big cook up today. Got the barbecue going and everything, so it's gonna be good.
Right.
So for today's topic, we actually asked the group what they wanted to chat about, and a couple of topics came up. So we're going to talk about a few of them. A couple of people wanted to talk about risk premiums and portfolio management. And then the other topic we're going to be covering is more about how Jordan actually trades, right? So Jordan hasn't been taking like a ton of the earnings trades with the group or anything like that. And it's because his book looks a little different. Some of the strategies he runs are a bit different, and I'm going to be asking him questions, trying to extract some alpha from you.
Exactly.
That's what it's all about. How can I stealthily get Jordan to leak alpha to the group? So let's start off with a conversation about portfolios and risk premiums. I think that's a good place to start because, we did that live, remember, Jordan, where we talked about improving your Sharpe ratio and managing a full portfolio. Mm-hmm. So let me start by asking you this question. How many strategies do you think the average person runs? How many strategies does a portfolio manager run? And why would there be a difference there?
So how many strategies does an active trader run? Let's say in a retail shop. It really depends on the person. Usually it's going to be a couple, maybe three strategies, maybe four strategies. On a portfolio manager level, it's probably going to be more because you can really scale. You really start to scale horizontally, right? So you just add more strategies into a portfolio, and that's how you scale. You can also scale vertically, but most of the time it's easier to scale horizontally.
Very cool. So what you're basically saying there is, let's say you go from having $1 million to $10 million. Well, strategy one might only have a capacity of $1 million. What are you going to do with that other 9 million?
Exactly.
You can't scale vertically there. You can't add more into that strategy. There's no value left beyond that $1 million. So you go and you add on another strategy.
Yep.
Now, besides just being able to take on more capital and it being something you have to do as you get bigger, what are the benefits that when a portfolio manager is building out these different strategies, what would be some of the things that they would look at, right? Because the reason I'm asking this, to make it clear, is some of our members and maybe some of the other people on this live, they're looking for, they're taking it very seriously, right? They're taking it very seriously. They want to have some forecastable return. They don't want it to be like a huge gamble. They want to actually think of themselves, and they do view themselves as their own portfolio manager. So what are some of the benefits of running these different strategies besides just getting more capital on the table? And what would a portfolio manager look for in these different strategies?
Yeah, it's going to add diversification. A lot of the time people, they'll get a whole bunch of strategies and there's really only trading the same thing. So for example, buying different sectors, right? People think, that's diversified, but the reality is that when things go down, everything goes down. So they're not really that diversified. An example of really two diversified strategies would be something that makes money when volatility is exploding, either to the upside or downside, versus a strategy that makes money when nothing happens. So there's really only two strategies, and that's long vol strategies or short vol strategies. And most people do short vol strategies, right? Buying equity. And so when you're building a portfolio, you got to think like, okay, well, if I add this to the portfolio, how diversified is it with what else is going on in here? Right. That's what's important. And, once you can establish that, and it has edge, it might be a good fit for your portfolio.
Yeah, it's like if you hold Apple, Amazon, Netflix, and Google, you don't really have a diversified portfolio, even though it's 4 different stocks.
Right. Exactly.
If you're long these 4 stocks, and then, or let's say you hold, I don't know, Walmart and Apple, right? Completely different sectors, sort of, and Tesla. Let's say you hold Tesla, Walmart, and Apple. You're like kind of diversified by industry, but at the same time, in a market downturn, it becomes one big bet.
Yeah.
Because they all go down together.
Right.
So how would you add that in, Jordan? Like, what would a portfolio manager do there?
Well, in that case, he maybe, let's say he thinks these stocks are the best stocks to buy. He'll buy those, but then he'll also look for the worst stocks out there and short those. And so now, if the market, let's say, crashes, well, these short stocks are, going to offset the losses on the long stock. So that's how he would do it, right? He would try to find other areas where he can, offset his delta exposure.
Very cool. Very cool.
Yeah.
So where does risk premium come into this conversation?
Well, it's like it's a way to trade, right? Is you find over or underpriced risk premium, and you trade that. So usually the way that I trade is like I look for something that's overpriced, and then once I find that it's over or underpriced, I try to offset it somewhere. So here's an example. I think Apple Vol is overpriced. And so, okay, well, if I think Apple Vol is overpriced, what can I buy to kind of offset that? So let's say I might go and buy some Microsoft Vol, or might go buy something, that's a little cheaper. But another way you can do it as well is look on the same terms, look within the asset, right? So for example, we might say, oh, look, the near dated options are extremely expensive. So I'm going to go and sell those. But I could go, let's say, 6 months out to the chain, and there's some options I can buy there that are, obviously going to be negatively correlated with my short vol. And I think those are more fairly priced. So I can buy those, sell those, calendar spread. And then, if I'm correct and the front leg is overpriced, well, then I'm going to earn on the strategy. So it's really just like a transfer of liquidity, right? Like where is something being, there's way too much demand. So I'll come in supply, and then I'll go and transfer that liquidity by buying something else that, is cheaper and doesn't have that flow coming into it.
So would you see the way you trade as providing a service to the market?
Yeah, for sure. When I trade, the market gets a little more efficient, right?
What other? Go on.
Yeah, let's say, for example, think about, everyone coming in by GME calls. If no one was there providing liquidity, that who knows what vol could have gone up to, right? If no one wanted to sell vol there, who knows what it would have gone to. So you have people in the markets that are saying, okay, well, I can provide liquidity here, and offset it by doing something else, right? Not a lot of people are just short naked on these things. They're offsetting it by buying something somewhere else. And, if those people aren't there, then the market becomes so much less efficient, right? So every time I trade, it's either because it's inefficiency or something's over underpriced. And so by me providing the liquidity, the person on the other side of the trade gets a better deal.
What are other ways that people view themselves in the market besides like a service provider?
I would say,
or do you think that's like where all good traders sort of end up, is viewing themselves in that way?
Maybe service provider is like, I wouldn't think of myself as a service provider, but it's like the acts that I'm doing end up making the market more efficient.
Exactly.
Right? Yeah. But like when I look at the lens, it's like when I'm looking through the lens, it's just like, hey, this asset's overpriced. Let me go and sell it. But in the meantime, someone on the other side is trying to buy a whole bunch of it, and they can't get anyone to sell it to them. Mm-hmm. Right. So, it kind of works out. And there's also times though, Sean, where it's like someone just doesn't know how to price something. It's a new product and they don't know how to price it. And they think they know how to price it, but they don't. And then so let's say you're a little bit smarter, a little bit faster. You come in, you price it better. And then, but yeah, then again, you're still making exactly, you're still making the market more efficient, right?
Mm-hmm. Very cool. We got a question here from Adam. He's saying, can you give some other examples of long vol strategies besides something like gamma scalping? Maybe something delta negative.
Trend following, right? Let's say, so venture capital, trend following, right? If you think about trend following, a lot of small losers, right? You get whipsawed. You get the breakout, you buy the shares, and it comes right back down. So you get a lot of whipsaw, but sometimes you get a nice trend. You get a huge winner. So trend following is synthetic long volatility, right? A lot of small losers, some massive winners. Venture capital, right? Venture capital. You're buying a lot of these companies cheap because of potential huge gains in the future. And so that's another way, that's another long vol strategy.
Very cool. So let's talk more about relative value.
Mm-hmm.
Like, what are some of the common misconceptions about relative value trading?
Common misconceptions about relative value.
Get wrong about it, like with the way they think about it.
Yeah. Okay. One of them is like it's super complicated. One of them is like it's super complicated. It's really not. It's really not that complicated, right? It can sometimes get a little tricky, but it's not something that is can't be figured out or can't be learned or taught. It's simply just buying something and selling something you think is more expensive, or cheap, or buying something that they think is cheaper, right? Usually have two legs, and one leg is usually the alpha leg. So this leg is overpriced and this leg is underpriced. But if you sell this, you're naked, and so you can buy these and then get more leverage in total, right? And so that's what I would say. I'd say one of the biggest misconceptions is that it's extremely.
So I'm taking that. Yeah, when you hear relative value, you sort of think like, "Whoa, okay, I'm not trying to be like Ken Griffin or something here. Why am I going to be looking at relative value? What am I, a market maker all of a sudden?" No.
Yeah.
But what I'm thinking as well is something you said there's kind of interesting, which I want to ask you about. If someone in the retail space is intrigued by the idea of relative value, how would you recommend they get started? And in order to run it like where you have both legs, clearly there's probably like a capital threshold that you want to cross before that becomes worthwhile. Or how would people at different levels go about managing a relative value trade? How would it change for them?
From which perspective? From a retail perspective, or?
Yeah, for a retail trader.
So usually as a retail, you want to trade one leg just because of the margin intensiveness. So remember we said like there's usually an alpha leg. One leg is overpriced or underpriced. You usually just want to trade that leg. When you start growing in size and you start getting better, let's say margin to add another leg, then you want to do that, right? Like for example, portfolio margin. Well, now you can add another leg that kind of reduces your risk. And this relative value can be, there's so many different types of it, right? You see it everywhere. You're just looking at two assets and saying, hey, are these the same? Are these together? Is something mispriced?
So something that would be important with relative value is that you're actually comparing apples and apples, right? You want to find apple A that's going for $1, apple B that's going for 80 cents. But how do you know when you're looking at companies that you're comparing an apple to an apple?
Yeah, company versus company is usually pretty tricky. Usually I like to do basket versus basket just because like those are easier to get out of line, right? Because you might have, let's say, only a few stocks in this underlying that are different but the vols are trading massively different because one is marketed as a space exploration and the other is marketed as like a value or momentum ETF.
Even though they hold the same stuff.
Even though they hold almost the same things, right? So stuff like that, I feel like can get out of line pretty, they can pretty much get out of line a lot, especially with all these new ETFs that are coming out every single day, it seems like. There's a lot of opportunities for these things to get out of line. That's what I would say there.
But yeah, so let's say you're looking at ETF versus ETF. Mm-hmm. How do you make sure that that what you're looking at are the same? Is it just the underlyings that matter?
Yeah. You can obviously, you look at the vols, right? You look at how they move. You look at their their relationships together. Then once you do that, you want to make sure that it's not just coincidence. You're not going to get stuck holding the bag here. So you look into the thing and you see, okay, well, how does this thing rebalance? What is this thing currently holding? And then you can find some really nice relative value trades there. Even like you can do component versus index. I mean, that's getting a little bit, it's going to be really difficult for retail trader to, let's say trade 10 different stocks versus one basket and try to capture a small dislocation there. But you see it on Twitter all the time, like people talking about, dispersion trading. It's like the infrastructure needed for that is extremely, extremely high. So I would just say try to keep this stuff as simple as possible, as few legs as possible.
Mm-hmm. Yeah, it's like, you want exposure to the thing that you think is wrong or inefficient in the simplest way possible. Mm-hmm. Right? Especially when you're in a situation where you can take a little more variance, like as a retail trader. It's not about like, we don't need like to have like the smoothest P&L in the world. It's like, as long as we get to the goal, we're good.
Right. Yeah.
So if somebody wanted to start learning about relative value trading, more about like how you view the market, obviously, I'm pretty sure everyone watching this right now is in PA. They could ask you, they could post in the group and we have some lives on it. But what else can they look into? I feel like it's not actually, besides the cryptic messages on Twitter that add like zero value, really. Yeah. There's not a ton publicly talked about. So where can someone look? Is there a book you'd recommend or one to follow?
Yeah, there was one. It was called, I can't remember the name of it actually. I'll have to post in a link later, but there was a really good relative value book that I did read. But you just think about it like this. Where can I transfer liquidity? Okay. Where is there an imbalance in supply demand? Okay. And then where can I, provide that liquidity there, whether buying or selling? And then what can I transfer that liquidity to? Okay. So for example, imagine we had S&P 1 and S&P 2, exactly the same two assets. And everybody was buying this. Okay. And everyone forgot about this. Well, you could come in and start selling this and transfer that liquidity to this by buying this, right? And then it kind of comes back into line, right? And you keep hitting it until it comes back into line. So think about that transfer of liquidity, okay? Where is there too much demand or supply? Where can I take that and offload it somewhere else, right? You want to transfer that liquidity. That's how you really just need to think about it.
You have any like a cool relative value story, like a trade that you saw that you're like, holy crap, I can't believe this is here, kind of thing, something like that?
Yeah, definitely. Tesla reverse calendar 2 months ago. So what we noticed was, the one Tico had. So what we noticed was the back month vols were trading at 77 implied volatility. The 2-year vols were trading at 77, 78. And the 3-month vols were trading at, I think, 60 or 59, right? And there was this massive spread between the two. So clearly there was a lot of buying pressure coming in on the back months. People borrow against their options and their warrants. So, there's a reason for them to want to keep it bid. So tons of buying back there and tons of selling in the front. So what we did, well, I just sold the back, but one of our members, Tico, what he did was he bought the Aprils or the Julys, whatever it was, and he sold the 2-year vol. And, of course, Tesla, plummeted 20% like a couple of weeks after. So he earned quite a bit, but eventually that came back into line. And that was one that paid off tremendously, right? It's providing liquidity somewhere where no one wants to provide liquidity in the back months. And he's being able to do that by buying some of the front months. So that's an example.
Okay, cool. Steve had a question here. He's saying, when talking about relative value, he says, are most of the people doing it against the components as a dispersion or against another asset?
Are they against the components as a dispersion?
Like, are people doing like basket versus components most of the time, or are people doing individual asset versus individual asset?
Yeah, it's usually basket versus basket. The days of dispersion, Steve, are in the past, man.
Why is that?
It's just too the edge is too small.
Mm-hmm.
Right? Think about how many legs you have on, right? Per trade. So
6,000 legs maybe over a portfolio.
So even if you, let's say, do principal component analysis and get, let's say, the top 5 stocks that basically move this index, that caused, let's say 80% or 90% of the variance in this index, you're still going to have a ton of legs here. And if you don't have the infrastructure for it, it could be tough.
And especially like with the commissions paid in the retail space, get very, very expensive.
Yeah, definitely.
Right. That's a big thing to always keep in mind, guys, like transaction costs, right? You're paying for all of these things and, every trade, right? Unless you're on Robinhood, but then I'm sure they'll see you coming in and the edge will not be there.
Yeah, it's actually pretty crazy. These market makers, they really drive me crazy sometimes. I had a pretty big order coming in, and I put an order for it was like $1.07. So the bid at the time was like $1.06, $1.15. I come in for $1.07. I got a partial fill, but then all of a sudden, this guy drops off to I think it was like 99 cents or something. And then as soon as the rest of my orders are filled, as I worked it down, he just came right back up, So they kind of get you sometimes. And anyways.
Yeah. They're against us, man. The market maker is against us. So with that being said, I guess we'll wrap it up there, Jordan. No need for a super long live today. I hope you guys found that valuable. Quiet day today. Everyone, Thirsty Thursday's got everyone a little hungover this morning, I think. But PA guys, we'll see you in the group. For everyone else, hope you have a great weekend, and we will be back at it on Monday.
See you guys.
See you around.